Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders and investors. Today, we're diving deep into a fascinating stock that's showing up on our hard-to-borrow screener, LGCL Limited, ticker symbol LGCL. We'll break down exactly what makes LGCL an intriguing case, how its sky-high cost to borrow could impact short sellers, and what to watch for if you're tracking potential short squeeze candidates. Show company logo and basic info. Let's get acquainted with LGCL Limited. LGCL operates in the technology/software application sector, and through its subsidiaries provides online agent-centric human capital management services based on a platform as a service, or PaaS, model in the People's Republic of China. This includes recruitment services for both flexible and permanent employment. Currently, LGCL holds a market capitalization of $56.01 million. Looking at recent price action, LGCL saw a slight dip of 0.76% today. Over the last 5 days, it's up plus 1.55%, but the past 30 days have been challenging, with the stock down minus 26.40%. Volume-wise, today saw 184,900 shares traded, which is significantly below its 30-day average volume of 5,026,520 shares, giving it a relative volume of 0x average. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why do we care so much about it? Chart animation. Short seller borrowing shares. When you short sell a stock, you're essentially borrowing shares from a broker and immediately selling them, hoping to buy them back later at a low price for profit. But borrowing isn't free. The cost to borrow is an annualized fee that short sellers must pay to hold on to those borrowed shares. Show graph. CTB percentage. Increasing a stock becomes hard to borrow when there's a high demand from short sellers to borrow shares, but very few shares are actually available to be lent out. This scarcity drives up the borrowing fee. In extreme cases, like the one we're seeing with LGCL, these fees can easily exceed 100% annually, sometimes much more. Imagine paying nearly 700% interest per year just to hold a position. It's an ongoing, significant cost that eats into any potential profits for short sellers, putting immense pressure on them to close their positions quickly. Why this stock is hard to borrow right now. Now, let's look at why LGCL Limited has landed on our hard-to-borrow screener. The numbers for LGCL are quite striking. The current annualized cost to borrow fee for LGCL stands at an astonishing 699.2%. Highlight 699.2% on screen, that's nearly 700%. Not only is the fee incredibly high, but its momentum is also extreme. The CTB has surged by plus 688 percentage points over just the last 5 trading days. This indicates a rapid increase in demand to short LGCL while the supply of shares dwindles. Speaking of supply, there are currently only 10,000 shares available to borrow for LGCL. Show 10,000 shares, compare it to its estimated float of 1.6 million shares. A float of 1.6 million is already quite small, making it easier for price movements to have an outsized impact, and with only 10,000 shares left to borrow, it tells us that the available supply is incredibly constrained. These factors combined, sky-high fees, rapidly increasing fees, and extremely limited borrowable shares, are precisely why LGCL is flagged as a hard-to-borrow stock. However, it's crucial to remember that a high cost to borrow does not guarantee a short squeeze. It can also signal that short sellers have very strong conviction that the stock will go down, and they are willing to pay a premium to maintain a short position. Squeeze mechanics explained. So, if a stock like LGCL truly became squeezed, how would that happen? Animation. Price rising rapidly. A short squeeze occurs when a stock's price suddenly jumps, forcing short sellers to buy back shares to close their positions. This buying pressure, in turn, drives the price even higher, creating a snowball effect. When the cost to borrow is as high as LGCL's 699.2%, the daily cost for short sellers is immense. If the stock price starts to move up, these short sellers face a double whammy: losses on their positions combined with those expensive borrowing fees. This can trigger margin calls, or simply make it too painful to hold their short positions, compelling them to buy back their shares. With only 10,000 shares available to borrow, if a wave of short covering starts for LGCL, there's very little supply to meet the demand, which could lead to very rapid price appreciation. Our internal composite squeeze score for LGCL sits at 50.5 out of 100, indicating it has some elements for a potential squeeze, but it's not in the highest echelon of candidates based on our criteria. Dilution risk check. An important factor in any short squeeze thesis is dilution risk. Dilution is when a company issues new shares, increasing the total number of shares outstanding. The graph shows outstanding increasing. This can effectively spread the company's value across more shares, depressing the price per share. For a short squeeze, dilution is bad news because it adds more supply to the market, making it easier for short sellers to find shares to cover, thereby negating or softening any potential price surge from a squeeze. We perform a thorough check for recent SEC filings that could indicate dilution, such as SMINUS-1, SMINUS-3, or 424B filings. For LGCL Limited, we found no recent dilutive SEC filings in the last 90 days, which is a positive sign for any potential squeeze thesis. Additionally, we checked for reverse splits, which can often precede further drops, and found no recent reverse split for LGCL in our look-back window. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for if you're interested in LGCL's potential as a short squeeze candidate? First, continue to monitor the cost to borrow. Will it stay elevated, or even climb higher? Also, keep an eye on the shares available to borrow. Will that 10,000 number shrink further? Share light data screen next. Look for a significant increase in buying volume for LGCL Limited. Remember, today's volume was far below average. A true short squeeze often needs a catalyst like positive company news or just sustained buying pressure from non-investors to ignite that upward momentum. Given LGCL's recent price performance, a reversal and sustained uptrend would be critical. Finally, be prepared for volatility. Stocks with high short interest and limited floats can make extreme moves in either direction. In summary, LGCL Limited, LGCL presents a compelling picture for those interested in hard-to-borrow stocks. Its incredibly high cost to borrow of nearly 700%, combined with extremely limited shares available to borrow and a relatively small float, makes it a stock to watch. While the lack of recent dilution is a positive, remember that high CTB alone is not a guarantee of a squeeze. As always, do your homework, understand the risks, and never invest based solely on one metric. If you found this deep dive into LGCL informative, please hit that like button, subscribe to the channel for more unique stock insights, and let us know in the comments below what other stocks you'd like us to analyze.